Good morning, good afternoon, good evening, folks. Michael Zuber, one rental at a time, back with his good friend, Mr. Dion from Dion Talk. How you doing, buddy?
Howdy, doing great. I'm excited, ready for round 5.
Awesome. So one of the things that, frankly, I think about and I get asked all the time is, okay, Michael, now that interest rates have exploded more than 200 basis points, what's going on in the housing market? You've heard my story about prices and transactions, but lo and behold, I've realized that we have this 52-year spreadsheet, which I give away for free, that actually has answers to that question. So I'm going to pull it up and we're going to go through it together. You okay with that?
Yep.
Awesome. So let me see if I can't share it.
While you're pulling it up, I'll remind people that you can get this spreadsheet just by signing up for Mike's free course, and then this spreadsheet is a part of that course.
Yep, it's in the bonus section. You will be logging in via Teachable. That's just where I have my stuff. That's who I pay. So what I'm going to call your attention to, folks, is this 52-year spreadsheet, which, again, just if you haven't seen it, I am a geek for data sources, so they're all highlighted. If you want to argue with the numbers, don't argue with me. Argue with the data source. They're listed here. We have ranges. We have decades summarized, but it's all there. Go play with it. If you want to know what's going on in housing, this is really economy, housing, CPI, wages, interest rates, all that stuff. It's here. But we are going to ask ourselves a question. Do we have a time where the 30-year interest rate, row 7, jumped 200 basis points or more? And if so, what happened to the housing market? So we're going to start, you know what? We're going to do this real time together. We're going to start way back in 1970, and we're going to go until we see a year that jumps. You ready?
Yep.
You're seeing this, right? I guess I should have asked.
Yes, it's on
Awesome.
screen.
Awesome. So, okay, 1970, 8.5. Oh, look at that. Rates went down. Rates went down. Oh, they're going up. They went up a point. They're flat. They're coming down. This is all the 1970s, folks. You see the year above. Okay. Oh, 11.2. That's almost 2%. There's our first year. 1979 to 1980. Interest rates jumped more than 200 basis points. That's what we suffered in the last 100 days. Does that make sense?
Yep.
Okay. So now what we're going to do is we're going to go look at housing transactions. We're going to look at row 4 and row 5. Why? Because I think the story is different, or at least it might be different. There's new homes in row 4 and there's existing homes in row 5. Okay. So interest rates jump in 79. Where were they? So let's base the year. We did 4.8 million homes total. We did 4.5 in the year that it jumped. And guess what happened the next year? Oh my goodness. It went from, what's that? 4.5 to 3.5? 4.5 to 3.5 in 1 year. Geez, this guy, Michael Zuber, is pretty good. What kind of fall is that? Let me see. Let's do some math. It's a million, right? A million fall. So 3.5 divided by 4. Wish I could do my calculator right. That is a 23% fall in transactions year to year. I have called on my channel repeatedly that we will see a 25% decline in transactions this year, and ultimately perhaps 50% peak to trough. So let's carry that logic forward. So again, folks, remember, we're basing it on this year. This was the year it went up, 4.5. So it went to 3.5. Then it goes to 2.8. Oh shit, where's it going to go next, folks? Where's it going to go next? Oh, 2.4. It went all the way down to 2.4. So let me see. It's not quite 50%, I don't think. So 2.4 divided by 4.5.
So Mike, if
47%.
If interest rates keep going up and transactions keep going down, well, then prices must be going down.
I am so glad you got there, but let's close this transaction one. Transactions fell 47%. That is supposed to happen. Demand destruction, supply destruction. Guess what, folks? If you had a mortgage rate back here at 8%, are you particularly excited about selling and getting a 16%? No, interest rate lock-in, supply destruction, all the stuff I have been telling you. I have talked about it 25 and ultimately 50%, not because I looked at these numbers, it's just because how the math works. But now let's go back to Dion's point. Interest rates shot up 200 basis points, 1979 to 1980. What happened to home appreciation? Well, 1980 doesn't matter because that's the year it went up. Oh, it went up 7% the following year and 4% the next year. Oh, then it only went up 1%. I don't see a negative number there, Dion. Do you?
No, but here's how the gurus are going to talk about a crash.
Sure.
There was 16% appreciation in 79 and only 0.8 appreciation in 83. They're going to call that a almost 16% drop in appreciation. It's not negative. It's not appreciating as fast.
Dude, I hope we don't let them. If any guru or channel out there tries to spin that story for you, you should immediately block them. All of these channels have been talking about a housing crash, and all of them have been saying 20% fall, 20% fall. They're not talking slower. No, that won't be acceptable. We should, no.
No, we will. We'll stick Matt on them.
Yeah. We'll get Matt the assassin to go after him. So the other thing to talk about is something I call real and nominal, right? So these are nominal housing appreciation, right? That's just the number that's printed. So let's see what the real appreciation was. In order to do that, we will go to CPI. So in this case, in 81, CPI is 10%. So the real home appreciation is negative, right? It is negative again in 82. It is negative again in 83. It doesn't turn slightly positive until 84. That's interesting. What about wages? Go ahead. Do you want to say something?
Yeah, it's really hard for I think the layman, myself, to grasp how inflation impacts price increase and value. So I get that this does make sense. And when you go to real, it's factoring that in. Again, that's going to be something that the gurus leave out.
Oh yeah, they're not going to talk about this stuff. They're so brain dead. It's not even funny. Yeah. So let's look at wages. Wages. Again, folks, this stuff is free. We probably have 50 hours of data in here. And again, it's all sourced, right? Go look at the sources if you don't like the data. But let's look at wages. Where are wages? Wages, row 13. So where were we? We were 84, right? We were 81. Sorry. So, okay. Wages. So we had 7% wage growth. Wow. Look at this wage growth. This is why the Fed, in my opinion, that's why we're repeating the 70s, whether you like it or not. And oh, by the way, the 70s sucked. I'm just going to tell you, as a kid that remembers the 70s, they were terrible. Wage inflation was really strong. I think we're going to have record wage inflation for the next couple of years. Yeah, I think, we already had 6% was reported Friday. So I think more is coming.
I think there's also a big difference between the 70s and now when it comes to wage inflation. In the 70s, our parents come from the generation where you could still have mostly pensions. So you were rewarded for longevity and work. So we were raised with get a job, climb the ladder, stay at that company, be loyal, you'll be rewarded for loyalty. Yep. And so that wage inflation that you're seeing there is people who stayed at a company, got these, COLA, the cost of living increases. We're seeing the same data now. Yeah. They're saying, 3 to 4% wage increase if you stay, maybe 5 if you stayed at the same company. But in the 70s, we didn't have the Great Resignation. It's still March again, was over 4 million that left their jobs. And unemployment is still lowest in like record times. Yep. So wage inflation now is in the 10, 15, 20% because it's a job change, not staying at the same place.
Yeah, I talked about it this morning on the Daily Financial News. 4.5 million people quit last month, record on record. We had 42 million people quit last year. Wage inflation is real and getting stickier. I think Friday we're going to get the unemployment number that goes down from 3.6 to 3.5, 3.4. Frankly, if you're an employee, I want to repeat what I said on the Daily Financial News. Go get that money. The time is good. Go get it. I think we have a recession next year. I think unemployment doubles, and that will be a time to stay put, right? Stay in place. That ain't today. Go get that. It's frankly your job. You owe it to your family to go make more money. And oh, by the way, don't spend it. Save it. Buy some assets. Come on. Be better.
But definitely don't pay down a low interest rate mortgage.
Exactly.
That extra money.
Exactly. So I think that answers the question, right? Have we had a time where interest rates went up 200 basis points in a year? We have. We've now talked about what happens to transactions, crash. We've also talked about what happens to price, up. Then we've adjusted for inflation and all of that. So lots of amazing stuff. What's kind of your closing takeaway?
It's always a great day to buy a great deal. And if you're not doing the work every day, you don't know what a great deal is and you'll miss it.
Yeah, I want to reiterate that. I believe the next year is the time where great investors who do the work are going to win. More of you are going to get a fourplex that was listed at 1.3 for 1.1 or a triplex or whatever it was than you. Lots of you don't believe me when I tell you the market is coming to us as investors. The more great offers you write, every great offer you write is closer to a yes answer. I wrote 100 offers in 2020 that was frankly stupid. I should not have had my agents write 100 offers. It wasn't the market for it. This is the market for it. Write great offers. Dion, one more time, where can people find you?
Right here on YouTube, Dion Talk Financial Freedom, where I tell you things like, you will be alive in 5 years. You should start investing like it.
I love that line. Thanks, buddy.
Ciao.